Mr. Schweikert.
Thank you, Mr. Chairman. And forgive me if this one becomes a little ethereal, but on particularly small, truly small businesses, you know, the one with under 25 employees that comes into an institution, and I don't know if this might be from a regulator standpoint. If it were a decade ago, and I'm coming in for working capital, do you feel, for those of you on the lending side, you had more flexibility? Okay, you have a couple trucks that you have equity in, all right, well, we know you own your home. And are the regulators not allowing you to look at their full asset bundle? And do you get punished if you've done that look at the asset bundle when you have your auditing mechanics? Mr. Green.
Congressman, let me start with that. I do think the flexibility has been significantly reduced. I mentioned the regulatory scrutiny and documentation. You know, a lot of times the primary asset of a small business owner is their home and equity in their home. To be able to take that equity now as collateral requires a whole lot more cost, a whole lot more scrutiny, a lot more documentation than it would have before. And the same goes for other type assets. So yes, sir, it absolutely has changed.
Well, in that same look on cosigners for debt, I don't know how many people in the room at some time in their life have had a family member wanted to start a business, and we were all really, really stupid or very, very loving, whatever you want to consider, and helping co-sign, you know, them to get some of their debt instruments to start their business. And my understanding is that also is one of the things I will see dramatically less of as being an acceptable collateral mechanic today. I mean, is what I'm being told your experiences?
Yes, sir. I'll just add one more comment, then let my other panelists other panelists talk about it. That is important because I mentioned earlier about character sometimes being the tipping point. A lot of those guarantors are family members, and having a family member on there, father, mother, that would guarantee it. A lot of times they were tougher on that borrower maybe than the lender would be because of that.
Well, it just makes Thanksgiving really uncomfortable when you
yes,
have problems. But in this one, and forgive me, is it Weirich? Wirsch. Now, you actually, with your position, you actually touch probably a lot of accumulated data. Are you seeing something in the data that's sort of outside the folklore we're having this discussion of, you know, why is it those small businesses aren't walking into their credit unions or their community bank to even ask for a loan? I mean, what do you see really going on in the data?
Really, I think it is the combination of factors. Demand is definitely part of the issue, and you know, in terms of some of these, the impact of regulatory scrutiny as we're talking about it, you know, it's interesting. If you look at the data, you see that and this is information that we can get in terms of why banks are tightening their lending standards. Regulation is less of a concern in terms of regulatory policy, regulatory scrutiny. That's the side that we're looking at it from. It's less of a factor now. The bigger factors in tightening lending standards would be you know, issues like their perception of the economic environment, their risk appetite, you know, those types of issues, loan performance, you know, their market strategy.
Well, in that area, when I have some of my regulated entities, you know, my community banks come to me and say, our discussion about our buckets, I'm holding too much real estate, I need to roll to this, roll to that. So there's entire silos of what you might have used in that cross-collateralization that, boom, are gone, that you can't use. And doesn't that ultimately, in that mechanic, have the cascade effect of, don't come talk to us, I have no capacity?
You know, I would just reiterate that, you know, lending decisions and the decisions about portfolio composition are truly, these are bank decisions and bank management decisions. There is an influence from.
Are they truly a bank decision, or I mean, I know that you're on the Fed side, not the FDIC side, but that's in many ways a regulator decision.
There is some there is some consideration of what the regulators, of the information the regulators give, and I think maybe from the banker side they can provide a little more insight on that. From what we see in the data, it just shows that regulatory policy is less of a factor in determining, the lending types of decisions. Now, in terms of, this idea of...
And I don't mean to cut, I'm
No, that's
over
okay.
time, but this is actually a really interesting discussion. At some point, I hope we can wrap to it, because I'm trying to mix what we get anecdotally with where we find actual data. So thank you, Mr. Chairman, and sorry for going over time.
Thank you, Mr. Schweikert. Mr. Chu.